Good evening. I'm Paul Ellis. I am one of the board members of the New York Technology Council. We're really pleased to have you all here tonight for our presentation, VC Finance Update, Growth and Opportunity in the New York Tech Market. I will start by introducing our moderator this evening. We're very pleased to have Greg David to moderate tonight's event. Greg writes a blog and a weekly column for Crain's New York Business. Following a 25-year stint as the editor and editorial director for Crain's, he also serves as the director of the Business and Economics Reporting Program at the Graduate School of Journalism at the City University of New York, where he teaches courses on covering the national economy, Wall Street, and New York City economy and business. During his tenure as editor, Crain's won 2 Gerald W. Loeb Awards for Excellence in Business Journalism, as well as General Excellence Awards from the Alliance of Area Business Publications and Society of American Business Writers and Editors. His upcoming book, Modern New York, The Life and Economics of a City, will be available in the spring of 2012. We're very pleased to have Greg with us here this evening. Let's give him a round of applause.
Thank you very much for that great introduction, and yes, I'd say the room says that tech is going on in New York. I was coming up with somebody in the elevator today and they said, oh yeah, you know, the alley's back, it's really bursting. Pause. And we think it'll stick this time. And I said, oh, I hope it'll stick this time. What we're going to do tonight is I have a couple of questions for our panel to get each of them to basically do their own introductions, but I'm going to start by telling you who is on the panel. At the far right is Thatcher Bell. He's principal of DFJ Gotham Ventures. Habib Kairouz is managing partner, Row Capital Partners, Inc. Warren Lee is general partner of Canaan Partners. Alan Patricof needs no introduction. He's been in this space longer than anyone else. He used to come to all these breakfasts I moderated for Crain's, and he'd like sit in the back. And I'd like to go up to him, and I said, well, you got to come to the front. You know, he was Hillary Clinton's most important fundraiser about then. And he never would. And Alan, I do have to tell you that for research for the book, I read the reread or reread. I couldn't remember the burn rate. But you'll be very happy to know I included none of it in the book. And next to him is Benjamin Wolin, who's CEO and co-founder of Everyday Health Incorporated. He's going to be sort of the truth teller here as we listen to the venture capitalists, or that's at least what we asked him to do. You know, there were always software companies in New York. Most of them provided good services to Wall Street because that was the great market in New York. And there were related businesses like information builders. I noticed a card from somebody there out on the table. Things changed in the early 90s. 2 people named Bob and Aline Stein founded a company called Voyager. Do you remember CD-ROMs? And they were the first people to create great CD-ROMs. And they were out in California. But you know, they spent all their time coming to New York, so they moved their company to New York. And that actually was the beginning of the 1990s new media boom. I found a much racier version of this story on the web, but I used the official one in the book. Meanwhile, in Atlanta, an engineer named Kevin O'Connor was trying to create software that would place ads online in a way that would maximize their exposure. An ad agency executive suggested he put together a network of websites to achieve that goal. And you know what? Atlanta was not a good place to run this business from. After all the ad agencies were here. Now, he was an experienced executive who had already created and sold one software company. He considered moving to California, but he decided against it and he came to New York, even though there wasn't a single law firm in New York at the time that could handle his business, and he had to use someone from the West Coast to do that. Of course, the company he created was DoubleClick. And in fact, the fact that the mayor goes around and says that Google is our biggest tech employer with 2,000 people is primarily because those are 1,000 of them are DoubleClick people, because Google bought DoubleClick. There are other stories, which is where the stickiness comes in. You know, about the same time in upstate Ithaca, 2 juniors at Cornell University decided to create a company at one point. One's name was Stefan Paternot. He was a computer science major. His buddy, Todd Kreiselman, was a biology student. They called their company Web Genesis. And you know what? They burst onto the scene in 1997 when a Cornell alumnus who happened to run Alamo Rent-A-Car gave him $20 million. Was the biggest investment at that time by a single individual in a company. He sometimes called them the kids. The company eventually became the Globe.com. And in the height of the frenzy, it went public and made one of the biggest jumps ever in internet history. It went public at $9 a share. The stock opened at 87 and climbed to 97 before closing in that first day at 63.50. Well, they didn't last, right? And neither did a lot of companies in those days. So the question is, what's happening today? Where do we stand? What's going to happen? And that's what we're going to tackle. Now what I'd like to do is I'd like to start and ask each of the VCs on our panel to introduce themselves, tell us a little bit about their history. And in my note to them, I said they had about 3 minutes. So we'll start with Mr. Bell at the far right.
I'll take a lot less than the 3 minutes. I think my bio is on our website, so you can have a look if you like. It might even be in the handouts. But I've been at DFJ Gotham for about 6 years. And for those of you who aren't familiar with us, we're early stage technology investors based here in New York. We're part of the Draper Fisher Jurgensen Global Network. And we spend most of our time looking at and working with companies in the financial technology, digital media, and e-commerce spaces with an influence or an emphasis, I should say, on mobile and on software and network infrastructure companies. My background, as I said, is available on the internet, but broadly speaking, startups, this is not my first venture capital firm, and consulting as well. And I have an MBA and as well as an undergraduate in mechanical engineering, which I don't use really at all. It's good to see everybody here.
I'm Habib Kairouz. I'm managing partner at Row Ventures. I've been doing this since '93. I had a full set of hair and it was all black when I got into this business. And I remember those days that you're describing, the glow, and we all lived those times. The firm's been around for 30 years. My partner started it back in '81. We invest across stages, across sectors. When I joined in '93, we opened it up to outside capital. We used to be dedicated to one family in the old days. We invest in IT, new media, communication, biotech, and clean tech. You could see us do a $1 million Series A round in a new media company or a $40 million growth equity round in a communication company. We look at early stage versus late stage in a very different way. We have an allocation within each fund that allocates to early stage, and the risk-return equation is very different than our growth equity pool, but ultimately, the asset that we bring to the table is the network that we built over 30 years, and we think that the relationships that we develop with entrepreneurs, partners, customers in the sectors that we invest in cross very nicely from early stage to late stage, which is why we've decided to be contrarian and invest across the different platforms. We've been New York-centric since the beginning. We also have an office in Palo Alto and Montreal, but we're very pleased to see the progress that we've seen over the last few years in New York, especially in the new media space. I personally focus on IT and new media, and a little bit on communication, and I have other partners who focus on biotech and clean tech.
Mr. Lee?
Warren Lee, I'm a general partner with Canaan Partners. We're an early stage technology venture firm. We're probably a little bit different than many firms out there in 2 dimensions. Number one, we invest in both healthcare and IT. So healthcare investment for us constitutes about 1/3 of our investment dollars. The balance is in information technology. In information technology, we do everything from semiconductors to services to software to chips, so we're pretty broad in terms of the areas that we focus on. So that's the number one difference. The second difference is that we we're a global venture firm with 5 offices, 3 offices in North America, 1 office in Israel and India, and we do all the investments out of a single fund. We think that's a good way of diversifying our risk across multiple sectors, as well as geographies, and it really forces us to sort of pick and choose the best investments in those 3 countries. Currently investing on our 8th fund, which is a $650 million fund that we raised about 3 years ago. Our first investment in New York was in '97 in DoubleClick, and since then we've continued to make investments in the media/internet space, In the last 5 years, we've committed close to $100 million in venture capital to a handful of startup companies in New York. So we're very excited to be here and look forward to the conversation.
I'm Alan Patricof, and it's interesting to hear you mention Voyager because I hadn't heard the word in so many years. My oldest son was the first employee they had here in New York, having moved from CAA in the West Coast. They were the first people in compact. They made the discs that were this large. Remember those?
The first thing they did was put a Beethoven symphony.
I've been in the venture business for too long, over 40 years, and I actually built another firm which carried my own name, and it was called Alan Patricof Associates, and about 10, 15 years ago I changed it to Apex, Alan Patricof International, because we became much more oriented towards Europe. We had 12 offices, and when I turned it over to the partners 5 or 6 years ago, we were running $35 billion, and they have a floor on the 53rd floor here on 601, Apex does. I left about 6 years ago because I wanted to go back into the early stage business. It's kind of a passion, and really felt the industry had gotten too big to be venture capital anymore. Apex, for example, does no venture capital. It's purely a mega buyout firm today. So I decided to raise a small fund, initially with just people I knew, and then I subsequently raised a second fund, and we took some institutions in. The recent fund's $130 million. I have an office here and one in LA. There are 3 partners and about 9 of us all together, and we focus on the internet and digital media, mobile investments. Business is doing very well. It's a great, my timing was very good, although we'll see what's going to happen in the next few years. But the timing has certainly been very good, and we've prided ourselves on our connections into the media, entertainment, network field, so that we bring that particular set of relationships to the investments that we focus on.
So my next question is, I'd like each of you to rate the state of the venture capital market in New York today on a scale of 1 to 10, 10 being as good as it could be, 1 being as bad as it could be. And those of you who've been around for a while could compare it to the 90s. And since you've been here the longest, Mr. Patricof, I think we should start with you.
I don't know how to apply a number. I would say that certainly I've never seen a startup early stage environment like we're currently experiencing.
Oh, Mr. Wolin? No, I introduced him, and we're going to come to him later. He's going to comment after we get a little bit out on the table here.
He's the only one who really works for a living. But it's a wild, exciting environment for the digital media world. I can't comment. I'll let Warren talk about biotech or healthcare investments, but for the internet and media businesses, it's been an excellent period of time. I'm concerned by the proliferation of startups at the moment. Particularly what's going on in New York is very, very exciting at the moment. It's probably the hottest place in the country. I guess I have to say, other than Silicon Valley, but I don't know how to measure it, but it couldn't be any more fervent than it is here and locally right now. The opportunities for people to start businesses, to raise capital, has never been better. The environment's good. 5, 10 years ago, if you started something here, you couldn't attract anyone. They'd all tell you about all the problems in New York. Today, people are coming here. They're moving their businesses from the West Coast here. It's a good time. I don't know how to give it a number. I think, it's good.
Mr. Lee?
So I guess just the number, I would say 7.5. I think the city's made a huge progress in the last 10 years, particularly in the last 3 years. I think there's a lot of growth and development to go, which is why I scored it lower than the 10. I think a couple things are New York specific in terms of just the necessary ingredients, whether it's the entrepreneurs, the startup lawyers, the bankers, just people know how to build startups, and you have people who've done it before, and it's always easier to do it the second and third time around. So I think we have a nucleus of entrepreneurs who've been successful in the past and are now their second and third startup companies. Having said that, I think venture capital and startup financing is changing, not just for New York, but just across the board. I mean, I sort of referred to Alan's comment. There clearly was a surplus of capital that went into this asset class, if you want to call it that, back in 2000, 2001. And certainly the last couple of years we've worked that off, and you're starting to see consolidation in the venture space, or at least attrition. There's going to be fewer number of investors out there, fewer dollars at work, and you've also seen the emergence of angel investors and incubators, which promise to build some of these companies in a much more capital efficient way. So I think there's a number of things that are happening both within New York, but also within the overall tech scene, and it'll be interesting to see how it plays out over the next couple of years. I do think that some of the ills that we suffered back in 2000, kind of an over-exuberance and over-optimism and over-funding, those are typical of venture funding cycles. And we wouldn't make money in this space unless there was cycles. And with the boom, there's always a bust, and part of the trick is to make money during the boom times. So I think we'll see what comes in the next couple of years.
That's pretty sobering. Mr. Kairouz?
So I think what's, in a nutshell, I would agree with, with the grade that Warren gives it. We've got, in terms of the amount of capital that's chasing the asset class, looking at it from the investor's point of view, as well as the returns, because at the end of the day, if the asset class doesn't generate returns, then we should all go home. We've gone from $100 billion of capital going every year into the asset class at the peak in 2000 back to that 25 to 30 per year, which is the number that we used to have in the mid-90s, 97 to 98. That's a very healthy number in terms of the opportunities that are out there. Innovation is more vibrant than I've seen it, even going back to the 90s. I mean, we'll see what's happening in the mobile world, we'll see what's happening in the internet world. We're in second and third gear. We're looking at businesses today that are generating real revenues, real profits. You'll hear from Ben later, and he's generated a substantial business that generates revenues and profits, not just eyeballs and promise that we had back in the 90s. And we're seeing innovation in a number of different sectors, be it the internet, be it the disruption of the magazine and the print industry, the next disruption that's coming in the TV industry. This is all within new media. Then you see all the opportunities in cloud computing for the automation of business processes. The same automation value proposition that we saw within an organization back in the 80s and the 90s is now extending to entire industries using the internet to allow business partners to collaborate and to work on specific business applications. So I think innovation is as vibrant as it's ever been. Where I worry about and where there might be a disconnect between the investor's position and the entrepreneur's position in today's market is that we're seeing some areas of exuberance at the seed stage and at the very late stage. At the seed stage, there's a lot of capital that's available for $100,000 to $1 million. That's, I think, allowing a lot of entrepreneurs to open their offices and get into business, and allowing a lot of companies to come in and again offer the same value proposition for the same customers. And I think the entrepreneurs could potentially be misled that the Series B rounds will be available and will be as easy as the Series A rounds were. From the investor's perspective, it's a small amount of capital when you look at the overall $25 to $30 billion going every year. But I think, and this is very specific to New York, where I think there's a lot of small amounts of capital that's coming in at the very early stage. So as entrepreneurs, I would urge you to think about what you need to do between that Series A or the seed round and the next substantial institutional round. And the other pocket that I worry about that could be more problematic to the entire asset class as opposed to the seed is some of the activity that we're starting to see with some of the hot companies out there, some of the activities that we're seeing, for example, on the second market platform or in some of the secondary transactions where people are coming in writing very large checks at valuations that are all based on projections that everybody expects the companies to make.
Mr. Bell?
So I agree with really everything that I've heard, and with Warren's grade. I think, even the half point is well taken. I would underscore a couple things Habib said. One with respect to a potential gulf between kind of seed and Series A and later stage investment capital for some companies. I would underscore the point that I think innovation and the ecosystem here is working very well. The only other two things I would add would be, one, I think the exit environment could be better. We'll talk more about that later, I think.
I think maybe next, after Mr. Wolin.
And then the second thing I would say is, this is true kind of globally at some level, but it's certainly true in spades in New York that the environment could, in my opinion, use, and I suspect we'll get consensus around the table, a lot more talent in terms of developers and technologists, and that's a pretty intractable problem. But that's the other thing that I think does slow or is slowing innovation, notwithstanding the rapid pace of innovation here.
Mr. Wolin?
Can I get a comment just to amplify what Habib said and make it a little bit more explicit rather than implicit? I mean, what he expressed is a concern, I think, of all of us, all of ours, at least it should be, which is the barbell effect that's happening. We have a lot of activity in the early stage, and we have a lot of money going in at, I'll call it a C round, but companies that are real companies, and we all know what they are: Groupon, Zynga, Facebook, et cetera, and we read about these in the paper every day, and that's had a psychological effect on the whole marketplace. And a lot of these investments are being made by funds that are very large, that have to put large money to work. And I personally am concerned, and I'm sure Habib is, and maybe I speak for others, that this type of investments, while it's great and it creates a lot of exuberance in the market, and it does permeate all the way down to the lower end, it has to, psychologically, for entrepreneurs who relate to those. And a lot of those types of companies expect to be going into the public markets, and they may be in for some surprises. We're all may be in for some surprises. The public window really never fully opened here in the last 6 months. It peaked open, but with what's happening in the last weeks or months, probably will shut the market or close it down, certainly to make it will be unavailable to a lot of people. Ben, who has a great company, can tell you, for example, their own situation. And so these companies are going to be around in a private market for a long time, and those kind of investors are going to be holding their investments for a lot longer than I think than they expected.
Well, we'll return to that in just a second, but we'll let Mr. Wolin take the floor and tell us what he thinks about what he's heard from the entrepreneur's perspective.
Yeah, sure. So first, in introduction, I founded or co-founded Everyday Health in 2002 in a kitchen in Brooklyn. That's what you do when you don't have a garage. Today, Everyday Health has about 500 employees here in New York and other parts of the world. We run a portfolio of about 30 health websites, reaching both consumers as well as physicians. We'll generate close to $150 million of revenue this year, and I'm lucky enough to have our largest investor and our first investor, Habib, on the panel tonight. And it's certainly a very different time when we started our company in 2002 and raised venture for the first time in 2003. So I would agree with most of what the panelists have offered. I think on one hand, it's a great time to start a company or be running a company. There's people writing checks, and you need that to hire people, pay the bills. When I started my company, there was no one writing checks. Everyone was running in a different direction. And the only way that we could raise venture capital was actually doing a merger with a company that was basically that had been invested in by Rowe and several others, and did basically a reverse merger to get the cash in that company of a business that was no longer operating. And that kind of gives you a sense of, people aren't doing those type of deals today. So on one level, it's great. On another level, I think there is an inverse relationship between the fervor and also how hard it is to compete and succeed. So a benefit of starting a business in a downtime is, competition is lower. We started by going out and licensing brands from big media companies, and everybody was willing to do that because everyone was running away from the internet. When everyone is running towards the internet or towards mobile, it's just more competitive. And so I think a lot of these early stage companies are starting to find out how difficult it is to go beyond idea or maybe $500,000 or $1 million of revenue and start to reach scale. So I think there's both great benefits to the excitement and the fervor, and then there's also the reality of when a space is white hot, see how competitive it is. There's probably 500 deal sites right now, and maybe 1,000 by the end of the next 2 quarters, and certainly the vast majority of those deal sites, as an example, won't be around a year from now.
Well, that leads me to my next question, so I'll go back to Mr. Patricof. Is Groupon really a real company? Is it, do you think its finances are such that they should go public, and would you invest?
Well, I think it's definitely a real company. Any company that's grown from nothing to, I don't know, whether we're $1.8 billion or $2 billion in revenues, there's got to have something there. I think they have 8,000 employees now. My numbers may be off, but it's grown very fast. So it's a real company. Does it have a protected position? I wonder. I mean, they're probably, the last number was 50, but it's probably up to 100 now, lookalikes. Everybody and his brother is starting a clone of what Groupon is. Anyone can discount merchandise. It's not very hard. I don't know about any of you, but in the last 2 weeks, every single day now, I'm getting a discount offer from Amazon. How many people are getting that here? That's the story. I mean, Amazon's hitting you every day with your local hairdresser or your local whatever, barbershop. I know I need a haircut. I haven't had a chance in the last month. But the competition is very heavy. So would I buy it? I mean, I guess the question will be what price, and when I see what the numbers are and what's happening. I mean, the market pays for growth rates, and everybody who's been buying in these second market type transactions that we read about every day, I think the last pricing, I don't know, I heard was 10 or 15 billion, and they're expecting to go public at 25 billion. That's all great as long as the quarter-to-quarter growth rates can be extrapolated. If there's a diminution in growth rates, you watch how fast people run the other way. So do I wish I had invested in it at $10 million pre-money? I guess I do. I mean, but which some people did, by the way. Would I be a buyer at 10 billion? You'd have to really convince me that the growth rate is going to continue for a long time to come, and that the profitability is going to be there, because the margins are getting squeezed.
Mr. Kairouz, you raised this issue? What would you like to say?
Well, I mean, I think Groupon absolutely has a real business, but their business is about acquisition marketing. It's going to restaurants, to merchants, and telling them we can bring you customers and give us an offer. But if you go through the economics of that offer is either break even or losing money for the merchant. That's not sustainable. You can't do that all day long. The only way that it's sustainable if you move your acquisition marketing into retention marketing as a second step. I think Groupon is better positioned than any company out there, given the database and the mailing list that they've built of consumers, to move to that second stage. But the business model has to evolve. If the business model has to evolve, it means the margins might change. It means the competitive landscape might change. It means the revenue share with the merchants might change. So people who are looking at the growth rate in the last 3 years and projecting that same growth rate moving forward, and the same margins moving forward at a time when they had no competition and they have 100 today, I think are missing the boat.
Well, it turned out they didn't have any margins. They were losing money. That was the big surprise. What did you think about that?
I mean, I didn't find it that surprising, given that...
well, they sort of led us to believe they were making money, and then they showed up with the fancy accounting. What did you think of that, too?
I think the interesting thing is when you have all these deal sites, we're a recipient of Groupon, Living Social, and many other deal companies, marketing dollars, and what has happened over the last 12 months has been an arms race on customer acquisition costs. Habib mentioned, does it work from the vendor or the merchant as Groupon and other companies fight to gain consumers? The big question in my mind about their long-term profitability, is it going to be cheaper for them to get a new customer, or is it going to get more expensive for them to get a new customer? And we've certainly seen just what people are willing to pay in the marketplace to get a new consumer escalate greatly. And if you look back at Amazon, they had some of those same dynamics, but over time, Amazon's ability to get new customers, greatly decreased in cost. And I think, there's a lot of opinions about will Groupon's customer acquisition costs go up or down, but in my mind, that's one of the most important metrics to their long-term success.
But I'm a Groupon customer, and I only buy deals for places I already frequent, or 90% of what I do is a deal at a place I already frequent.
But that's okay. But I think what Ben's hitting on is probably half, maybe it's a little more than that, but it's half the economics. The real bet that one has to make is that once Groupon has you in their email database and they're chasing you down the street with the merchant offers as opposed to waiting for you to come to the merchant, that second offer that you buy is going to cost much less. So it's all about how often are people going to go to the Groupon offers and buy them. And if you don't have a lot of offers, people will do it all day long. And that's what I'm talking about in terms of moving from acquisition marketing to retention marketing. And at that point, then the sky is the limit.
Let's bring the issue back to New York for a minute. I'd like each one, and we'll start on the end with Mr. Bell. Tell us what you think the hottest areas are in New York for venture capital, either generally or for you specifically. And be as specific as you can.
So, we've alluded to some of these already. We were just talking about daily deal sites. There still is a proliferation of those. Full disclosure, and I was partially intentionally quiet in that last discussion because we're investors in a daily deal aggregator site called Yipit. And the thesis there, and our thesis generally on the space, is actually that we expect that proliferation of those sites to continue for a variety of reasons. And that, in any case, so we continue to see those kinds of companies. I think there are a couple of major sort of fundamental innovations that have taken place in the last few years that everybody in this room has probably thought a lot about. The fact that pretty much everybody in this room is carrying a computer with them that fits in their pocket. The proliferation of social media. So there's the local, mobile, and social kind of triumvirate, and we're still seeing a great deal of new companies being formed around those fundamental innovations, and I think we will for some time. So that continues to be very hot. I think in New York, we're seeing and have seen for the last couple of years a lot of companies in the fashion technology space, and those can be e-commerce related or not. And not just because of the panelists here, but I think health, the sort of intersection of health and information technology is an area where we're seeing a lot of startups. And then the last I would mention is anything sort of cloud related in terms of infrastructure. So I'd say Amazon and EC2 and others may have locked up some of that infrastructure, but there's been a lot of innovation and continues to be at other layers of sort of the cloud technology set of platforms. So, we talk about specific companies, but I just start throwing out some of those.
Mr. Kairouz?
I think, obviously we've seen a lot in new media. We're seeing increasingly a lot of very interesting opportunities in financial technology, back full circle to where the industry started. The next big area that's interesting to us, although we haven't yet invested in, we only invested in one company, it's based outside New York, but there should be a lot of opportunities in where I think the next big disruption in new media is, and that's interactive and the connected television space. We're spending a lot of time looking at the space. We're starting to see some very early stage ideas there, but I'm hoping that that's the next big one.
Mr. Lee?
So the hot spaces that I've seen have already been mentioned, so I'll take this question in a slightly different direction. I think one of the areas in New York that's interesting is, maybe compared with our brethren up in Boston or California, is that we have a large proportion of consumer-facing internet type of companies. Basically, we have fewer B2B type of companies, although we do have them, but fundamentally we have a number of startups here that are somehow engaged in acquiring customers and either getting them, monetizing those customers or users through either advertising or some sort of transaction type of system. And I think one of the interesting things is that that's great, but I think one of the things that we certainly see in the daily deals area is this idea of consumer fatigue. So how many daily deal companies do you need, really? How many e-commerce companies beyond Fresh Direct or Amazon are you willing to subscribe to? How many location-based social networking type of companies do you really want to install on your Android or iPhone? So I think what's interesting is the barriers, relatively speaking, today to create a consumer-facing internet company is fairly low. Certainly lower than they were 10 years ago. So it's fairly easy to do. And I think what you have is just an overfunding, oversupply of these companies. And I think it will be a very different picture in 12 to 18 months. And I think disproportionately that's going to impact this city because we have so many sort of consumer-facing type of companies.
Mr. Patricof, anything you want to add?
I can't add too much. I think, though, Warren's comments are absolutely right, correct. I mean, I'm not giving you new areas, but New York is very heavily dependent on content, advertising. I don't know about so much about e-commerce, but certainly e-commerce goes with that. And the one thing none of us in the venture business ever talk about, including myself, is we're going through this recession, we're going through this terrible business environment, and somehow you never hear at any venture capital panel or any venture capital discussion how the economy is affecting our companies. And to a great extent, it's because they're small, they're growing at growth rates that, if you're $1 million, it's easier to go to 2 million than if you're 100 to go to 200. The infrastructures aren't there, your cost structure isn't there. So we've been pretty, I wouldn't say protected, but I think so far, at least our portfolio has not really been affected by the economy. But I am concerned about, sooner or later, it's certainly going to hit advertising, and advertising is a big source of revenues for a lot of our companies. In terms of interesting opportunities, I think I hate to agree again with Habib, but I mean, I'd like to be original, but I think and I was the Clinton Global Initiative today and yesterday, and the president of Rwanda said no one in our country will ever know what a landline is because everybody's got a mobile phone. It's just taken over the developing world, and they just jumped. And mobile banking and mobile payments is a very hot area all around the world, and it's here. We just made an investment in a young company some of you may use called Venmo, which has become a very hot peer-to-peer payment system. I think the whole payment world is a big opportunity, but also the TV. The reason I mentioned mobile was in connection with TV. I mean, the TV as we know it is going to change dramatically in the next several years. Convergence is really here today, and we're looking at something right now that could blow your socks away, which is the ability to trap a signal in a very, very simplistic fashion, and represents new technology. And I think there's going to be a lot of new technology in how you use your iPad in relation to the TV experience itself. So I would agree with Habib, that's a good place to look.
Mr. Wolin, is the economy affecting you, or is it affecting your plans for the future?
I think, compared to late 08, early 2009, that there was a much greater impact that we felt. And our customers are large CPG companies like Procter & Gamble, Kraft, or pharma companies like Pfizer, Abbott, Lilly, and there has been some impact, obviously, but certainly not the pausing and stopping of marketing that we saw so substantially in late 08, late 09. I would say just one other point about the health of the New York venture scene and content, new media companies, is that for a lot of the environment to continue to flourish, I think the larger companies really need to succeed. And by that, if you look at a comparison against the West Coast, where you have companies like Google and Cisco and Oracle, who bought a tremendous amount of companies that were coming out of Silicon Valley, I don't think the same is the case here in New York, especially in the content new media scene, where big media companies have been suffering tremendously, have been unable to go out and buy, or unwilling to. Certainly AOL is not in a position of strength. And I really do think that we need to see those companies succeed, especially a company like AOL, for a lot of these great entrepreneurs to have a home to put their companies, and for VCs to get a return on their capital. So I think it's a big issue that I think about a lot, and when I talk to the other media executives that or internet executives that we all face.
So, Mr. Wolin, you're in the camp that think it does matter that New York has not created a Facebook or a Google.
Absolutely. I mean, I think if you compare, the last 10 years, or, from 98 to 2002, and then after that, you had an environment where you had Yahoo, Google, you had many companies out that got to real substantial revenue scale and were generating enough cash flow to buy businesses out of cash, and their stocks were appreciating. That is not, if you just compare that to AOL today, they're not generating enough cash, nor is their stock appreciating that people are going to sell them their business. So I think, people, DoubleClick was one of those stories. DoubleClick got purchased. There aren't a ton of big, large new media companies. I mean, we're one of the biggest in New York, and we're relatively small. We're not going to go do a $200 million cash acquisition right now. We can't do that. I'd love to, but that's not the reality of where we are. So I think we either, those large media companies either need to turn around, and we all can prognosticate about how likely that is, or some companies like ourselves and others really need to get to the next level so that we can buy the next health IT company, or the next mobile health company, or health deal company, or whatever it is.
Yeah, someone in the media business, the second option is more likely, I'm going to turn it over to questions from the audience in just a minute, but I'd like to do sort of like a rapid round, and I'll start with Mr. Bell. I'd like you to ask each of you to give me one strength about New York City in this space. Try not to repeat the one in front of you, and then when we get to the end, we're going to go backwards with what are the biggest weaknesses. So, Mr. Bell?
I'd say one of the biggest strengths is no matter whom you're selling to, that your proximity to your customers or prospects.
Mr. Bell, I wasn't going to pick that one, but
it gets harder, but
thanks for that.
And not on the second one. The second one should be easy.
Having said that, I actually would say that the biggest strength today is that we have entrepreneurs who are on their second and third company, as opposed to back in the early 90s. Most of the entrepreneurs had just left banking and consulting, and most of them went back to banking and consulting. If you remember that B2B, B2C word back in the 90s, people like Ben started out in the late 90s, stuck it around in the really bad days in the 01 and 02 timeframe, and now have built real businesses with real revenues and real profits. People like Dave Morgan started companies like Real Networks, sold it, and Real Media sold it, and then started a company called Dakota. He's now on his third company.
And he's older, too.
But that's exactly how the ecosystem develops. So I'm not as concerned about the fact that New York hasn't yet created Google and Facebook, because Google and Facebook were created by entrepreneurs in an ecosystem that's been built for 40 years. We're in the second gear in New York, where the industry is only 10 years old. It's going to happen, and it's starting to happen.
Mr. Lee, one positive.
Oh, it's clearly the world-class VCs that are based here.
That's good, Mr. Patricof.
I have to agree with Ted.
Gotta give us something new, I make my students do that.
The custom, the argument you make to everybody in this business is that you can't be on the West Coast, and if you're going to sell to the media industry, it's here. But I would say, if I have to be original, I'd say there's a lot of creative talent in New York that is there's a real concentration of much more so. So if you're doing something that has a creative, you can say everything's creative, but I mean creative in a content standpoint, I think this is a great place to be.
So Mr. Wolin, since you're last, I'll give you your choice. You can give us a positive, or you can start the negatives going back.
Well, I was going to say the subway system was the most positive thing. Proximity, access for creative people. Just going to tie it all together. I think New York, it's a great place to start and run a small business and grow a business for all the reasons these guys said. You know, there's capital, there's your customers. We're, tonight after this event, we're hosting an event for 500 people for our annual sales party. Everybody's coming locally. We're going to have 500 advertisers and customers down at the standard. You couldn't do that in San Francisco. It's absolutely true. The whole agency world is here, and to have a real business, you need revenue.
Okay, you get to start the negatives, weaknesses.
Weaknesses. I don't know if Warren that mentioned this. I think technology, the ability to hire great tech talent is a challenge here in New York. Now, getting a site live or a mobile app live has gotten so much easier. You used to talk about how many servers you had to buy and all these type of things. That you don't even have to think about that anymore if you're an entrepreneur yet. If you're a small company and you're competing with Goldman Sachs and Citibank and JP Morgan for software talent, that's a challenging environment. And I think one of the reasons we expanded our footprint beyond New York was for that simple reason of having access to engineers. Now, we're not running to Silicon Valley because I don't want to compete with Facebook and Google for engineers, but certainly other mid-sized cities close to universities are important for us to succeed. And I don't believe personally that we'll be able to continue to grow our business at the rate that we need to by just relying on New York technology talent.
If the mayor brings Stanford or Cornell here, will that make a big difference?
Sure. Everything helps a little bit. But
help a little or a lot?
It's hard for me to know. I mean, I think it's a competitive environment. I think under any circumstance, we'll be hiring engineers outside of New York. We won't stop hiring engineers in New York, but we'll need to look further afield.
Mr. Patricof, a weakness?
I think New York's the best place in the world to operate. Best place to live.
We're on the weaknesses part. We can skip, you can skip, but no more positives.
No, I have to echo and say, I do hear occasionally, not so much anymore, that it's hard. There isn't as large a technical talent pool here as people would like, but it's nothing like it was. It's a hell of a lot better. And the other thing I want to mention, we've all forgotten, the most successful media company in the world probably is started in New York and employs thousands of people, which is Bloomberg. Just because there's only one.
I dissent. It's not a media company. It's a Wall Street company.
Oh, well, you're wrong.
Run like a Wall Street company.
You're totally wrong. You're totally wrong. And come with me to lunch with Norm Perlstein tomorrow and tell him that. He was managing editor of Time Inc. and he's now running.
I know.
And they put out plenty of content, and you can.
I've been there a lot, I've been there a lot.
Bloomberg TV every once in a while. So.
Mr. Lee, do you have a negative day for us?
So I think, at least for me, the biggest negative is still the fact that we don't have a couple or a few multi-billion-dollar standalone venture-backed startup companies that have successfully gone public and have remained independent. And it doesn't have to be a Google or a Facebook, $50 billion. I would just love to see a few $2, $3, $4 billion companies out there, companies of size, and because I think it just reinforces the ecosystem that we built here.
It's very depressing to hear that the world, our fate hangs with AOL. Holy cow! Mr. Kairouz?
AOL was started in Reston, Virginia.
We have too many West Coast VCs opening satellite offices in New York.
And Mr. Bell?
Liked it much better before.
So I think I'll take a crack at maybe going in a different direction with the talent problem, the tech talent problem. I would say we don't have the level of partnership, and this is not to say that NYU hasn't made some incredible efforts and Cornell isn't coming down here. I'm a Cornell alum, and that the Applied Sciences Initiative is not a great idea. which again is a Cornell alum. I hope Cornell gets that, but whether it's Stanford or someone else, I think that'd be great. But the fact is that, you know, I don't, in spite of my efforts to do so, probably walk the halls at Columbia or NYU or any of the universities here in New York as much as my venture colleagues do, you know, who come from Sand Hill Road and walk around in Stanford or in Berkeley. And, you know, I think we probably all make our own efforts, and that's not to say we couldn't do that more, but I think that's a very powerful partnership, and we could get more out of it.
Time for questions from the audience. Mr. Wolin's going to leave a little early, so if you have any for him, you need to start. I guess we're over there.
Hi, here we go. Hi,
We have mics, and please stand up.
Oh, sorry. I got a question. I think it's for Habib or Alan. You guys have a lot of excitement about interactive television or convergence, and thinking back over the past 10 years, there are a lot of dead bodies on the side of the road in that field. What exactly is different now that makes it so exciting when you have a huge amount of invested capital that's going down the toilet in that field, you know, by major companies, venture capitalists? I mean, the list goes on.
Which one of you would like to start?
I mean, there's one thing in our industry that you have to get right, and it's timing. 10 years ago, you didn't have the infrastructure to make it happen. You didn't have the broadband connectivity in the homes to allow for interactivity to be there. And today, every new internet, every new TV set is being shipped, and it's going to have an internet connectivity attached to it, and broadband penetration that will allow video over broadband to be displayed on the TV sets is a quality that the consumers want. So the infrastructure is ready to deploy the applications. And you no longer need to interact with it with the remote control. You can interact with it with this, you can interact with it with the iPad or any other sort of internet-connected device.
I think the answer I would give is just a nuance of that is that it's all been dependent before on a piece of hardware, and today it's becoming virtually independent of another independent piece of hardware.
I think it's already here. I mean, Xbox Live has 30 million subscribers, it's bigger than Comcast. You know, it's you know, that is a version of interactive TV. So I think that you know, in some cases that some of that stuff has already happened at scale.
In the middle here. Yep. In the green shirt, you're up.
Yeah, we got down there.
Oh, we've got somebody with the mic.
Yeah, right here.
Yeah, I'm Bob Dombrowski from the Sustainable Business Incubator over in New Jersey. I was just wondering, you made a reference to the big engineering school that's going to come over, and I read an article by Bloomberg that says he wants to track some of the top engineering and science, hard science minds in biotech, green, clean tech. There's a whole carbohydrate economy going over in Europe where they're making chemicals and materials from carbohydrate feedstocks to replace petroleum. And it's being pushed in Germany, it's being pushed in England, it's being pushed in France.
What's the question? What's the question?
What do you think when that hard science really starts to coalesce and create non-IT companies? Will you guys invest?
Anybody want to? We're doing it today.
Okay.
We're investing in exactly what you just described.
Okay.
We're just not betting the entire fund on it because the business model is not yet proven on how to make money in venture capital.
Yeah, so I want to ask basically the inverse of the first question that was asked about television. So, so what I've seen with a lot of VCs is a lot of reticence, especially around the content side of TV. And a few of you might have actually seen a particular company that I'm talking about, so don't relate to that exactly. But how does VC get comfortable? And actually, Alan, you've done this with Huffington Post and some of the other stuff, but around both the technology of this interactive TV and where it hits the content, and not just, is there room to blend in that Hollywood or even New York culture with VC culture?
I think it's hard. Content has always had a real problem with, in the venture community, people just have a difficulty getting comfortable with it. So I don't think you're going to see a big rush. On the other hand, you know, Huffington Post, is it content? I mean, yes, it is. I mean, then that's the case, then every blog site is content. But I think when you talk about content, I think what you're referring to is creating a new TV show, going in the movie business, where you're making large bets on pieces of content which may have, either successes or failures, and I don't think the venture industry is oriented to, or will it ever be.
Okay, we'll stay in the middle for one more question before we move.
Actually, I'll present a kind of a contrarian view and disagree a little bit with my fellow panelists. I actually am pretty not bullish about convergence on television. I used to come from Comcast. I was an investor there, so had plenty of scars on my back investing in IPTV type companies. I think there's three trends that you guys sort of look about. Number one, consumer behavior ultimately is slow to change. I think we all get comfortable in watching television, which is, it's a passive/active type of experience, and it's becoming more interactive and more active. But sometimes you just want to veg in front of a television, and that's a very comforting behavior that you want to maintain. Number two, I think referring back to my question around scarcity of attention, today we have so many choices. It's not like 10 years ago where if you wanted television, you had to pay for it by satellite or cable. Today you can get it in a number of different places, and you can pay for it, you can be ad supported. So I think just the incremental value of getting a slightly better consumer experience or content experience has been diminished over time because you just have so much choice. And the third thing is, I think, similar to the print business, where you now have content farms just churning out crappy content. And basically, it's hard to differentiate between high-quality, professionally produced text content versus more user-generated, robotic-driven types of content. I think the similar type of thing will happen with video. I mean, there always will be a demand and premium pay for professional, Hollywood-produced, cable network type of content. But I think there's so many sources of video content out there that there's only so many hours in the day that you can watch a video. And I think that starts to meet, maybe not this year or next year, but I think 3 or 4 years from now, the problem is not finding the content that you want to watch. It's actually filtering out all the content that you could want to watch but don't have time to watch.
If you would just join me for a second in thanking Mr. Wolin, who has to leave. We'll excuse him at this point.
My question is, how has the Bloomberg of life sciences, RFP, the emergence of new satellite VCs, changed your strategy? Have you been looking to raise more capital, build more partnerships with some of the incubators here, like Thatcher, or even planning to build a strategy with whatever campus comes here? And also, is there an opportunity to raise more capital from, let's say, like the New York City pension, because they're looking at commercialize more technology and businesses here?
Has anyone changed their strategy because of this, or the other efforts the administration?
I'm on the board to select the university, so I can't comment on it.
And I'm trying to lie.
No. I've been told you're advising. You don't get to select. They're selecting themselves. You're advising.
Advise.
And I already said
we had a meeting, so advise.
And I already said I'm trying to lobby Alan and others on behalf of Cornell. So, I probably shouldn't comment either, but. I would say, the fact that have decided to spend some time on that is partly because I care about Cornell, but also in no small part because I care about New York. And I'd say that's an independent decision from our firm, but that and other developments in New York, I think, will influence our strategy going forward. Just as the dearth 3 or 4 years ago, it's hard to believe now, but the dearth of seed stage capital at that point influenced our strategy to start making seed investments.
I was in an edit board meeting with the president of Stanford at Crain's, and let me tell you, the only question I had at the end of it was, you want this so badly, what are you going to do if you lose? His answer, by the way, was Shanghai will want him.
So, I think one of the interesting things, it's great that Bloomberg is pushing this initiative. New York certainly needs, whatever sources of academic resources you can build or attract in New York is great. But I wouldn't overestimate the impact of bringing, whether it's a Cornell or Stanford, to the city. I think it's one piece of the puzzle. And the reality is that I think one of the dangers here is we shouldn't be comparing ourselves to Silicon Valley. A lot of times newspapers and stuff like that, it's like,
Well, the mayor did that, The mayor says we're going to overtake them. That comes right from the mayor.
So that's fine. But I think New York City has unique assets and unique things about New York, whether it's the proximity to media companies, advertising companies, the density of the city, so we can experiment with interesting mobile devices. I think a mistake would be to try to copy the Bay Area. The Bay Area is going to be unique. Silicon is going to be unique. So I think it's probably more interesting to think at what's unique, what are the specific strengths about New York, and how we leverage those attributes to build a different version of Silicon Valley as to try to copy Silicon Valley. We should actually just stand alone and be known for our types of companies.
We got one back here. She's been waiting a long time.
Oh, okay.
Okay, so one idea for partnerships with engineering.
Can't hear you.
One idea for partnerships.
Is it
You
on?
said it's on.
Flip the thing up there.
Okay. One idea for partnerships with engineering schools would be to hold these events in the various schools in New York City, and there are 6 of them. Another idea is maybe to create an entrepreneurship fund where you would have a competition between these engineering students and see what creative ideas they have in the technology field.
That is happening. I mean, go to the New York Tech Meetup. There are 1,000 people the first Tuesday of every month in the Skirball Center. You can't get in. It costs you $10. Whatever the first Tuesday is in October, you'll go down and see a lot of them. And there are competitions all over the place. There's the Lang Prize up in Columbia. There's the Startup Network down at NYU. It's happening. This is a very fertile area.
You've got a question here in front.
Well, we always hear about all the good things, but what's one industry that you guys wouldn't invest in right now?
That's a good one.
I can tell you personally, I wouldn't invest in the biotech industry. I learned the hard way. I'll leave it for someone else. It's a capital intensive, and by the way, I wouldn't invest in clean tech either. These are capital intensive businesses that take a long time, a lot of money, and I'm sure it's good for somebody, but I just don't have the stomach for it. It's
Okay, Mr. Wee, what don't you have the stomach for? Well, you don't have the stomach for interactive TV. Do you have another one for us?
So I don't like clean tech just because it feels to me, at least for a large percentage of those clean tech deals, more like project finance than venture capital. Venture capital, we're looking for fast-growing companies that exit within 10 years. Just on the point with Alan around biotech, I think you can be successful in it selectively. I mean, it's sort of like semiconductor space. It's capital intensive. But the good thing about biotech is that there is a ready pool of acquisitive pharmaceutical companies. And you don't have to take the drug all the way. You don't have to take it to market. You can generally prove out a couple trials and demonstrate the efficacy of a particular drug or a treatment in a small pool of candidates. And at that point, what's good is that drug companies will generally buy you. And I think being very selective, not all biotech is successful, but being selective about the subsectors that you're looking at could be a lucrative way of investing.
Mr. Kairouz?
There's a big laundry list of some of the mature markets that we're no longer investing in, where you're fighting big gorillas with traditional enterprise software, traditional communication equipment, places like that. We're no longer investing there. We're looking for recurring revenue models in some of the emerging areas. But even within the emerging areas, for us, for the size of our fund, even though we're investing in early stage and late stage, we're ultimately looking for each company that we invest in a potential to build $1 billion business, which for some earlier stage, smaller size funds could be fine to invest in a company that can exit at $100 to $200 million and could be really impactful on the returns of the fund. For us, we can't invest in those businesses because you end up spending a lot of time with them, and ultimately there's no impact on the fund. So we're looking for stories that can stand on their own as standalone companies, as opposed to needing to find a home with one of the large consolidators.
Mr. Bell?
I just echo a couple things that folks said, and to Habib's point about not investing in businesses that have large incumbents that have been there for a while, even within information technology. Just in the last week, I got, I think, 2 proposals for business plans in the ERP software space. And not that there is an opportunity there, but it's going to be a tough slog, I would argue. And to Warren's point about biotech, I, A, don't know anything about biotech, but B, even if I did, notwithstanding his point, which I think is well taken, I don't really have the intestinal fortitude for that, because I prefer to invest in businesses where if there's not, what's effectively an IP acquisition, that there's an underlying business to fall back on that can support itself. And smarter people, with respect to biotech, have figured out how to make a lot of money without that, but that's just my kind of preference.
Here in front, we'll go.
So I had a question. The question was, are we heading into winter, and how are you preparing your portfolio companies for it? And somebody brought up the article in the New York Times, I guess Bloomberg was starting a fight with Silicon Valley, and somebody made a comment that I think it was Eric Rees said, I'm concerned that, I think it was Eric Rees said, I'm concerned about New York because, and it's true that, full disclosure, I'm bi-coastal, I go back and forth. So, but it's very true that Silicon Valley has had more downturns, so they're prepared. They've been through enough wars, and people are saying, the thing with New York is that they haven't had enough downturns. So my question was going to be, do you think we're going into a winter? What we had in 2009 here, and if yes, how are you preparing for that? And do you agree with that New York doesn't get ready for the
Mr. Lee is saying no, so we'll give him a shot at the microphone.
Yeah, so I think maybe the first downturn, we were unprepared, like in 2000, it was a massive shock, and everyone suffered, but particularly in New York, just the lack of experience and familiarity with the cycle, probably hit us worse than it did California, which, cycles are commonplace there and people expected. I think it's been 10 years since that time. We've gone through at least 2, I would say, cycles, mini pops and things. And even with the downturn in 2008, what I was surprised at was not the companies that did fail, but that there weren't as many companies that did fail. Maybe you don't hear about them. But I think everyone's been sensitized in the last decade that, at the first sign of trouble, people are cutting expenses. We've seen a number of raises in the last 9 months here in New York specifically, where companies are raising war chests. Companies are raising $20, $30, $40 million. And, is that going to be used to grow their businesses organically? Probably not. They're strengthening up their balance sheet. That's number one. Number two, I think what's different now versus 10 years ago is you see an influx of, California VCs. I think last year, if you compare the number of California VCs leading the largest venture rounds in 2010 versus 09, I think it tripled. Something like 17 of the top 25 venture deals in 2010 were led by California-based companies. So I think what that means is the investor syndicates in New York, within New York, is more diversified. It's no longer just a lone New York VC, but you have they're co-investors with a number of California VCs, and it's much more well-diversified. So I think these companies will have access to a pool of capital among several investors, and I think that just bodes very well in terms of these companies' ability to sort of withstand a downturn.
And you think we're going into a winter?
I don't know if it's I don't think it's a winter. I think it's going to slow. Certainly in the next 12 to 18 months, I would expect that it's going to be a slow growth environment, meaning it's either flat to 2 to 3% growth. But does it fall off the cliff? Hopefully not. But I think the likelihood is kind of a slow growth, no growth type of scenario.
We would agree falling off the cliff would be bad, though, even in your sector, which is, to be clear, in the last couple of years, it seems to me you've been insulated from the shocks that have hit the rest of the economy. But if we head back into another significant recession, it will be different this time, right?
I would take a more aggressive answer to your question. I actually respectfully disagree with the statement that New York entrepreneurs are not as ready as California entrepreneurs. If you look, I know you're repeating it. New York, the last downturn prior to the internet bubble blowing up was in the late 80s, early 90s. The entrepreneurs who were around back then are very few. The entrepreneurs today are the ones who started in the business in the mid-90s, and we've gone through exactly the same cycle. I would argue that New York entrepreneurs are much better prepared because the bulk of their tenure as entrepreneurs has been in downturns. Has been the 01 to 03 downturn, the 07 to 09 downturn, and now if we hit another one, it would be our funds that started in 99 to 2000. During the holding period, more than 50% of the years that we've been building these companies have been in recessionary times. So I think they're very prepared, and I actually think that they're much better fiscally prepared and than the California counterparts, because there is a culture in Silicon Valley that you go for broke and you swing for the fence because it's a home run game. And the New York entrepreneurs who almost went bankrupt and couldn't pay their rent in 01 and 02, like Ben Wolin. Ben Wolin started at BeliefNet, and they were on a shoestring for a long time. His partner was at iVillage. I was on the board of iVillage. We were on a shoestring for a long time. So these companies are very well prepared. When we went to the board meeting at Everyday Health in 2008, and I was coming in with my whole list of things that they needed to do because we were going into recessionary times, they were way ahead of me. They had all the plans on all the things that they needed to cut, how they were going to survive the downturn. I didn't even have to add anything.
So we got about 5 minutes, so what I'd like now is really direct and to the point questions so we can get a bunch in, and we're in the back over there.
Yeah, it's kind of a related question. What level of urgency would you put on the market right now for a CEO to go out and raise capital? I guess the question is, at what point does the well go dry?
The question is, what is the urgency for these companies to raise capital? And I guess it comes against, you know, the prospect. Somebody raised the question that exit strategies are problematic, I would say, especially after today in the market, right? So what's the urgency for people to go out and raise capital?
I would say that you certainly, just what Warren's saying, a lot of companies are today socking in large amounts of money, frankly, because it's available. So I certainly would urge anyone to take advantage of that and don't run a tight ship financially going into the next 12 months. I think having a comfortable balance sheet will make you sleep at night. Let you sleep.
We'll do it in front and then we'll go over there.
Hi, this question is specific to IT investments in the New York area. What impact does the presence or absence of a mature angel community like the Band of Angels have on your deal flow? And secondly, the Y Combinators of the world. We're starting to see some of those crop up here in New York. Like, how does that impact your ability to really kind of source quality deals and kind of nurture them?
It's terrific. I mean, their deal flow for us, I mean, you know, seed deals even today are generally less than $1 million, maybe $1.5 million, you know, so finite amount of money to prove out something. And eventually, if these companies are successful, you start to hire salespeople, you start to hire marketing people, and you'll probably end up having to raise a $5 or $10 million round. So for us, we see a larger number of better prepared seed stage companies come out and raise the Series A round. So it actually makes life easier for us.
I'm going to go in the middle there. Then I'll go back. And then I'll go back there, and that'll be it, I'm
Yes,
afraid.
I wonder if you could comment on how entrepreneurs or venture capitalists are taking advantage of the fact that New York is a global city and a global financial capital. It's not something I've heard spoken about as an advantage.
I would say probably not enough. I mean, it's just not the psyche of, it's not New York. Well, maybe it is New York. There's not enough. You know, in Europe, where I've had a fair amount of experience, when you start a company, you start up and the first thing you're talking about is exporting, and the U.S. is a big market. Certainly in Israel, that's all it's about, is selling and marketing to the United States and Europe. We have such a large market. We have a distorted point of view, and it's, you know, if I saw a company, I think, at least it was in the old days, I haven't seen one recently, and if they came into me and gave me a business plan and told me their first 3 customers were in France, England, and Germany, I probably would say, what's wrong with you when there's such an enormous opportunity here? So I'm not prejudiced against it, I just don't see a lot of it. It usually comes at a later stage of the company's growth.
We're in the back.
And they have a different point of view.
Are any of you concerned about the political landscape when this mayor, who is very business savvy and supportive, is no longer the mayor?
Ooh, that's a touchy question.
You lean forward first. The politicians can always mess things up, right? Not just in New York City, even at a national level or international level. So yeah, you're always concerned about what the impact will be on the macroeconomy, but I don't think Mayor Bloomberg would take credit for what's happening in New York.
Oh, yes, he would.
He didn't know, to be fair.
He does, every day.
He's certainly been a significant supporter and an ongoing driver of this industry and this sector, and there are a lot of initiatives that we're all involved with that have his full support. But will he stand up in front of a crowd and say, I created a new media industry in New York? I don't think so.
He comes close. Actually, I think it's a very good question. In my book, I'm going to argue that indeed the 2013 election will determine the future of New York, because the attitude that Ed Koch put in place, that this was not, as he once said in the New York Times, they used to want this to be the #1 welfare city in America. Well, I want it to be a place where there is activity and where there are jobs and where businesses and people stay. And he used to go up on 3rd Avenue, I've been told, and he would be getting ready to go in the car at night, and he'd look around and he'd tell the people with him, these are my buildings. These are the buildings I spurred. Well, the attitude in New York, Ed Koch, as the person who covered him the most at the Times told me, changed the attitude of New York mayors who, in my view, saw business and the economy as a place for tax revenue. And that attitude has lasted till today, but I would argue that the contenders for 2013 don't agree with it, and that they would agree with the kind of attitudes that John Lindsay brought to bear. But we shall see.
I think Christine Quinn listens to a lot of people in the business community. I would say, I know her, and de Blasio is business oriented, so I'm hopeful. I understand what you're saying, but I'm hopeful.
Well, I disagree on those 2 points. And those 2 people in particular. Can you join me in a round of applause for our panel?